Welcome back. In this first part on the equity valuation process, we have an overview of the steps in the valuation process, followed by an explanation of the first two steps, that is, to first understand the business, followed by forecasting the company's performance. Let's dive right in. There are 5 general steps in the equity valuation process. The first is to understand the business. A study of the industry structure and the company's competitive strategy, together with an analysis of financial statements and other company disclosures, provides a basis for the next step, which is to forecast the company's future performance. This usually includes forecasts of sales, earnings, dividends, and financial position. The analyst will also select the appropriate valuation model depending on the characteristics of the company and the context of valuation. The next step is to convert the forecasts into a valuation before applying the valuation conclusions. The type of conclusion depends very much on the objective. This could be an investment recommendation, an opinion about the price of a transaction, or an evaluation of the economic merits of a strategic investment. Let's have an overview of each of these steps. Understanding the business consists of 3 sub-steps: understanding the industry structure, a competitive analysis of the business, and financial statement analysis. Essentially, we're trying to answer 3 fundamental questions. How attractive are the industries in which the company operates in terms of offering prospects for sustained profitability? What is the company's relative competitive position within its industry, and what is its competitive strategy? And how well has the company executed its strategy, and what are its prospects for future execution? Let's start with industry analysis. This is usually done using the Porter's 5 forces framework, which you've learned in Level 1 and will be repeated later in this course. We shall just quickly run through the 5 determinants of the intensity of competition in an industry, namely the rivalry among existing competitors, the bargaining power of buyers, the bargaining power of suppliers, the threat of new entrants, and the threat of substitutes. Besides an analysis of the current state of the industry, the analyst should also look out for any factors likely to affect the industry's longer-term profitability and growth prospects, such as demographic trends. Next, understanding the company's competitive strategy. In general, a company that can create and sustain an advantage over its competitors warrants a higher valuation. Porter identifies 3 generic corporate strategies to achieving a competitive edge. Cost leadership is the strategy of being the lowest cost producer while offering products comparable to those of other companies. Low-cost carriers employ this strategy. Product differentiation is the strategy of offering unique products or services that are widely valued by buyers, such that the company can command premium prices. Premium airlines often employ this strategy. And focus is the strategy of seeking a competitive advantage within a target segment of the market. When based on cost leadership, we term it cost focus. For example, a low-cost carrier can choose to focus on the domestic market. When based on product differentiation, we term it differentiation focus. A premium airline that focuses on business travelers will fit this category. Once the analyst has identified the company's competitive strategy, he can evaluate the performance of the business over time in terms of how well it executes its strategy and how successful it is. This can be done by studying past annual reports to assess how the management has historically foreseen challenges and adapted to changes in business conditions through time. For public listed companies, gathering the required financial statements is not difficult, as the securities regulators mandate the regular filing of financial statements and disclosures. Besides the regulatory filings, the analyst can search for press releases and investor relations materials like recordings of investor conference calls. Third-party sources such as industry organization publications and commercial providers of market intelligence may also be referenced. The key consideration in examining all these documents is to assess the quality of earnings. We've learned this earlier in FRA, so we'll just highlight some of the key points here. High-quality earnings are characterized by 2 important elements. Firstly, it should be adequate, meaning that the earnings should at least cover the company's cost of capital. Secondly, it should be sustainable. Sustainable earnings are earnings that are expected to recur in the future. Earnings sustainability may be assessed by estimating the recurring earnings or the persistent earnings of the firm. Most analysts regard operating income as recurring earnings. The non-recurring items that appear after the line are considered non-sustainable and hence low-quality earnings. However, classification of items as non-recurring can be highly subjective and hence is open for manipulation. Operating expenses are sometimes misclassified as expenses from discontinued operations. The operating income is higher, but net income is not affected. This can give the illusion of high recurring earnings for the company. The analyst should be wary of large special expenses, or when the company is reporting unusually large operating income for a period. The shortcoming of using recurring earnings as a yardstick for earning sustainability is the subjectivity in determining which items are recurring and non-recurring. Now let's look at the other aspect, which is earnings persistency. Earnings can be viewed as being composed of a cash flow component and an accruals component. Capital markets research shows that the cash component is more persistent than the accrual component of earnings. Here, greater persistency means that, compared to accruals in the current period, the cash component in the current period is more predictive of future net income. A relatively higher proportion of accruals can be interpreted as lower earnings quality. Besides assessing the quality of earnings, analysts should also watch out for warning signs of earnings manipulation. The two major vehicles of earnings manipulation are through revenue recognition and through capitalization of expenses. Let's start with revenue recognition. Revenue is the largest and most important element in the income statement. As we've learned, revenue recognition practices are determined by the management, and it makes revenue somewhat subjective and vulnerable to manipulation. As such, you as an analyst should not only be concerned with quantity of revenue, but also with the quality of revenues. That is, how those revenues were generated. For example, revenues generated via deliberate channel stuffing, or as a result of bill and hold arrangements, should be considered spurious and inferior. Even relatively genuine revenues, when secured via the use of heavy discounting practices, come at the expense of deteriorating margins. One good starting point to identify such manipulation techniques is to evaluate the revenue trends and compare them with the industry average. In terms of expense capitalization, we've learnt in Level 1 that certain expenses are capitalized and depreciated or amortized in the subsequent years. This has the effect of shifting expenses incurred in the current period to future periods, so current period income is higher. One warning sign of abuse of this process to prop up current earnings is the unsupported increase in the proportion of non-current assets on the balance sheet. There could be a systematic capitalization of expenses underway. For example, if the net profit margin increase is accompanied by a corresponding build-up of non-current assets, this may be a sign of excessive capitalization of expenses. Another warning sign of cost capitalization is when there is an unexplained decline in asset turnover ratios, but revenue is steady. This implies that the increase in assets does not produce additional revenue for the company, which is a sign of excessive capitalization of expenses. Another useful tool is to compare depreciation expense as a proportion of total asset over time and with peers. If the depreciation expense is proportionally much lower than the industry, this also warrants further investigation, as this could be a sign of the company delaying depreciation for higher current period income. And lastly, check for problematic related party transactions. An example would be if the company is shifting resources to a privately held company that's owned by senior managers. Also, watch out for propping practices whereby profits from related entities temporarily prop up an ailing public company. In summary, these are the three key aspects to understand the business. Understand the industry structure and the competitive landscape, what's the company's strategy to compete, and evaluating how well the company has executed its strategy by analyzing the financial statements and the quality of its earnings. The second step is to forecast the company's future performance. There are two approaches to this: the top-down forecasting approach and bottom-up forecasting approach. A top-down forecasting approach moves from international and national macroeconomic forecasts to industry forecasts and then to individual company forecasts. For example, a revenue forecast for a manufacturer could start with GDP forecasts, which translate into industry sales forecasts, and down to company sales forecasts. Alternatively, a bottom-up forecasting approach aggregates forecasts at a micro level to larger scale forecasts. The specifics may depend very much on the type of company. For example, a retail conglomerate may have several divisions, and each division may have its own individual stores. The analyst could forecast sales for all the individual stores and aggregate the forecast to sales for each division, which in turn aggregate to sales for the entire group. And that concludes this first part on the valuation process, where we discussed the gist of the first two steps. In the second part, we'll learn the remaining three steps in the valuation process. See you again.